Hey there, it's Tom Ryan, founder and CEO of ICR. Before we get into the next episode, I wanted to ask that you subscribe to the show. It'll help us get even more unique and interesting guests on the podcast and in turn continue to educate management teams and the growing ecosystem that creates value for fast-growing private and public companies. And while you're at it, head over to Apple Podcasts and leave us a 5-star rating. Very much appreciated.
The C-store box itself has gotten a lot larger. Traditionally, it was maybe a sub 2,000 square foot store. Today, the modern prototype is 5,000 to 7,000 square feet.
In my lifetime, convenience stores have gone from a place where you grab a pack of smokes or maybe a bag of chips to a full-service retail and food experience. And among the people reaping the benefits of that growth are the real estate investment trusts.
Today, we're 99.7% occupied. Rent collections, I think we were at 99.9, and we've been about 100 over the last couple of years.
Being a public company can be hard. Small missteps can have outsized consequences. I'm Tom Ryan, founder and CEO of ICR, and over the last 25 years, we've helped thousands of companies understand and navigate the stock market and the media. We'll demystify these and other increasingly complex stakeholder groups so you can focus on what you do best, building your company and unlocking your true potential. This is Welcome to the Arena from ICR. When you stop to fill up your car for gas, how often are you also hopping into the store to grab a quick bite, Gatorade, or maybe that carton of milk that you forgot to buy at the grocery store? These kinds of retail interactions are so commonplace right now, we barely even think about it. But one company has managed to leverage those experiences into a real estate empire. Chris Constant is the president and CEO of Getty Realty Corp, which trades under the symbol GTY on the New York Stock Exchange. Chris joined the company in November of 2010 as Director of Planning and Corporate Development, was later promoted to Treasurer in May of 2012, Vice President in May of 2013, CFO also in 2013, and CEO in 2016. Prior to joining Getty, Chris was Vice President in the Corporate Finance Department at Morgan Joseph and began his career in the Corporate Finance Department at ING Barings. Let's enter the arena with Chris Constant. How did your experience kind of lead you to Getty, and how did that opportunity come to you?
Yeah, so I guess, I started coming out of college in 2000. It's a really interesting time to join the world of finance. I got to see the very end of the dot-com boom and then the subsequent bust. And eventually I found my way to Morgan Joseph, which was a small M&A boutique. And I got to see the exponential growth. I think I was employee 10 or 12, and we got up to 150 or so people until the GFC came and really closed down middle market M&A and middle market financings. But just a really great experience, for building a company, meeting a lot of really great people.
Yep.
I worked with a gentleman named David Driscoll, who was on Getty's board. And when the board asked one of our co-founders, Leo Leibowitz, to retire at the young age of 85, David came off the board in April 2010 and became president and CEO. And then, I was looking to do something a little different. And he and I were friendly and were chatting. And he was looking for someone to come out and really start this planning and development function. And so in November 2010, I came out to Getty, and just a really interesting experience. When you're on the advisory side of the world, you're offering your advice and you're saying, okay, this is the right path forward for your strategy, or how do you think about raising capital or buying or selling a business? And you get out to a company and you're kind of creating that strategy. And then if you're going to execute on something, then you've got to live with the outcomes there. Yep. So that was sort of probably the introduction to going from the advisory side to working for a company. It was a smallish company headquartered in Jericho, New York. And it was a never-ending list of things to do. And it's been an exciting journey that's coming up on my 15th year anniversary in November of this year. So,
yeah, congratulations. I mean, you've had an amazing run, and I think it'd be really great to go back and talk about the origins of the company, which is a real success story. How did the company start, and maybe where does it stand today in terms of scale? Because it's obviously a big operation.
Sure. The company was founded in 1955 by two gentlemen, Leo Leibowitz and Milton Safenowitz. They bought one gas and service station. And then the next 15 plus years, they acquired individual stations, small portfolios of stations. And they actually went public on the Amex in 1971 under the name Power Test. And at that time, they were a large regional owner operator and fuel distributor. And this probably predates the days of the convenience store.
Yep.
And then really the transformational moment for the company was 1985. Getty Oil was being acquired by Texaco because of the FTC, right? They had to divest some of their retail stores and some of their distribution contracts in the Northeast and Mid-Atlantic regions. And so Leo and Milton were able to acquire 600 stores from Getty Oil. They bought 1,500 fuel distribution contracts, and they also got the name. So the name went from Power Test to Getty Petroleum Corp overnight. Business significantly expanded. In the late 90s, they split the businesses. So you had the operating company, which was called Getty Petroleum Marketing, and then Getty Realty, where I am today. At that time, 90+% of our rent and probably 95% of our properties were all associated with the legacy properties. But if you really fast forward to today, we've got 1,125 properties. Less than 300 of those are some of the original properties.
Yep.
And about 10% of our rent comes from those original properties. So what we've really been able to do is take what was this great platform, right, and some fantastic properties that would be really hard to buy in today's market because they're Boston down through DC, all along that Amtrak corridor, really infill locations. But sold some properties, we've redeployed that capital, and then we've raised capital and bought properties all over the U.S. So today we're in 44 states. About 60% of our rent today comes from C-stores, and then we've really diversified across what we call these convenience and automotive retail markets, which would include C-stores and car washes, auto service stations, and quick serve restaurants.
There are a lot of people listen to the podcast who, we cover all kinds of industries. What's a net lease REIT?
Public real estate investor, right, who buys, freestanding, single-tenant commercial properties. And as part of a triple net lease agreement, generally these are long duration leases. So our initial term is usually 15 or 20 years and has modest fixed annual increases, but our tenants are required to pay all the taxes and maintenance and capital improvements during the term of that lease. So it's really, if you think about the economic trade, we have stable, certain cash flows for a very long period of time. But a lot of the what we call additional rent or CapEx is transferred to the tenant, which is maybe different than some other sectors of real estate.
Yeah. And you talked about the focus on convenience, automotive retail. What are the characteristics and benefits of those industries that make you really comfortable and excited about, the opportunity that's in front of you?
Yeah. So I'll start out by saying we were fortunate to inherit that portfolio that I mentioned a little earlier.
Yep.
But if you think about what gets us excited about it today is these positive fundamentals around convenience, speed, service, this transition in the consumer economy from wanting to do it for yourself versus do it for me. Particular in the C-store and the QSR sector, the quality of food, the brands that people are able to build, how they're embracing technology to drive customer visits is all very exciting. And you can see the ramp in terms of how people are using their apps and loyalty programs. And then if you think about on the auto service side of the business, all the statistics around people holding cars longer, cars becoming much more complex to maintain.
Yep.
I'm not changing my oil anymore or washing my car anymore, right? People tend to have services that do that for them. And in each of these sectors, what you're seeing is not necessarily new unit counts across the U.S., but just the building of brands and consolidation. And, when we think about our counterparties on our leases, right, we really want to be with these large national or large regional operators, right? Because you get the credit quality behind the lease, but you also get the power of scale. Right? Whether it's sourcing auto parts or whether it's building your food brand and creating that customer network that can stop at any one of your locations. That's what really excites us.
Yeah, let's stick on the convenience store because I know when I was a kid, they didn't exist. And then I don't know, maybe as I grew up, you could go in and get like a Coke and pack of gum or whatever. Maybe talk about, since you joined the company, the evolution of that and kind of what you're seeing now. What you're seeing maybe 3 to 5 years from now in that segment, because it's really cool what's happening.
You're right. So, 15 years ago when I got to Getty, the major oil companies were a lot of the operators, right? They're really focused on fuel volumes and pushing their brand. And then as you start to see the C-store develop, obviously oil companies didn't want to be selling snacks and getting involved in food, right?
Yeah.
So they divested themselves from a lot of the retail real estate. But you had this opportunity, if you were an operator, to build a retail brand. And what's happened over time is the C-store box itself has gotten a lot larger. Traditionally, it was maybe a sub 2,000 square foot store. Today, the modern prototype is 5,000 to 7,000 square feet. It's going from what you described, your traditional snacks and sodas, to like a lot of times there's maybe partnering with a nationally branded QSR like a Subway or a Dunkin'.
Yep.
So today, when you think about the modern C-store, it's part restaurant. It has seating inside. It's got a great coffee presentation. In certain markets, they're selling beer and wine and craft beer and pretty high quality things. And it's also a mini grocery store. People buy milk and fruit inside C-stores.
Yeah.
20 years ago, that would never have happened. So it's really been a tremendous evolution. I credit our tenants, many of whom come out of the gas side of the business, for really embracing the challenge to become a great retailer in the U.S. And you've seen just tremendous success stories.
I know there's a lot of other REITs. Some are more substantial in size. They're in your space, kind of targeting that freestanding retail. What do you tell people when you're asked, hey, what's your competitive advantage, with this kind of targeted approach?
Yeah. Well, we're fortunate that the sectors that we invest in are all fairly large across the U.S. and remain fairly fragmented. So there's certainly a lot of opportunities for all of us. But you're right. I mean, if you think about some of the positive trends that I talked about earlier, it's competitive.
Yeah.
So we definitely have to differentiate ourselves. We've got deep knowledge in all of these sectors. A lot of times we're talking directly with management teams about how they're thinking through growth, whether it's their plans for M&A, whether it's new store builds, think about how they're managing their balance sheet.
Yeah.
And then our track record. We've been in this since, like I said, the mid 1950s, right? But as a REIT, we've been public since 97. And I think in the sectors that we operate in, we're known for being thoughtful investors, being good partners, and good stewards of not only capital from a shareholder standpoint, but also good landlords, right, for folks who are looking to help grow those businesses.
Yeah, I'm glad you brought that up. I have to think a lot of the value that gets ascribed to your company has to do with kind of your investment and underwriting process. And, if you've been doing this since 1955, you must have it down pat in a way. But talk about how you find potential assets. What are the criteria? What are the steps that kind of bring things from, the top of the funnel down to the bottom where you kind of act on it?
So I'd say, from a sourcing standpoint, about a third of our company is involved in the acquisitions piece, whether it's sourcing, underwriting, credit evaluation, closing. So we've got a fair amount of resources dedicated to that. About 80+% of what we do is direct, meaning that we're sourcing the relationship or we have the relationship and it's either a new deal or it's a repeat deal. And the other 20% is probably a marketed package because there's a lot of advisors that focus on net lease real estate. When we source an opportunity, right, we're really trying to look at it from a holistic standpoint. We're really focused on real estate. We like properties that are in the top 50, top 100 MSAs.
Yep.
If you think about the convenience thesis that we have, we're looking at where is that property? Is it easy to get in and out of? Is it on a corner? Is it at a traffic light? Can you make a left-hand turn into it? And we've got folks here who have been in real estate for far longer than I have that evaluate all of those aspects of the properties. We're looking at the operation. That's probably the second piece to it, right? Which is, does it have all the attributes that I discussed, right? Food, beverage. If it's a car wash, is it the modern state-of-the-art prototype? If it's an auto service, right, is it that brand that's got the network and they're really trying to take advantage of repeat customer business? And the third thing is evaluating our tenant partner, their credit, right? Because this is a long-term fixed obligation for 15, 20 years on a base term plus renewal options, and then their business strategy. I think one of the things that we've come to really appreciate about our tenant base, I'll go back to COVID and through the various periods that have followed where we've had some moments of stress in the economy, you've got to be a good operator.
Yep.
And you've got to be forward thinking in these sectors. The consumer can be fickle sometimes, right? And You've got to be able to track customer visits. You've got to be able to retain that customer once you get them in your store. And we're really fortunate that we've got great tenants and they're really embracing technology and embracing brand building. And our portfolio has been fairly stable and resilient over the last several years.
Yeah, I was going to say, maybe you could comment a little bit on occupancy and rent collections and tenant and rent coverage. I know you're very solid across the board on those things.
Sure. So we'll talk about our in-place portfolio. So, net lease in general, people like stability inside the portfolio. Today, we're 99.7% occupied. So we have 3 vacant properties.
Amazing.
All of which we have plans for, and they're in various stages.
Better step up your game there, Chris,
Yeah. Rent collections, I think we were at 99.9, and we've been about 100 over the last couple of years. I'll go back to COVID just because it's interesting, right? We were, again, all open. I think in May of 2020, we collected 95% of our rent, and that was the trough for us. Some of that was deferred, which we ultimately collected by the end of the year. So we've been very, again, fortunate that our businesses are healthy. And I guess that's the next point is the health of our tenants. 2.5 times is our rent coverage right now. It's been fairly stable, 2.5 to 2.7 over the last 5 years. And what we're seeing is just stability inside the C-store. We're seeing some nice growth inside the car wash sector. So we're really comfortable with how we underwrite, set those rents when we go into these new lease obligations. And we've watched our tenants be able to grow their profitability as our rent also grows.
So obviously, the focus on convenience stores and auto services worked out very well for Getty and their shareholders, and their record of identifying solid businesses to add to their portfolio really speaks for itself. I wanted to know if they saw similar potential for growth in any other sector.
We're constantly evaluating where we take the business. We really are committed to growing and diversifying Getty. So we certainly look at other sectors, but I think where we start is, again, thematically, that the consumer trend, speed, service, convenience. We want to make sure that we're consistent with who we are and what we believe in as we look to expand. We added car wash in 2019, auto service really in 2021, and then QSR at the end of 23. So we've been steadily expanding what we call our buy box. But as we do that, one of the things we recognize is we've got to build those relationships. We've got to create transaction opportunities for ourselves there. So it does take some time once we commit to a sector. Along the way, we've evaluated a number of sectors that we've probably said, not for us or not right now. One that I would just point would be maybe pharmacy, right? Obviously you've seen some store closures there. There've been some tenants with some stress. Not to say all of those properties themselves are uninvestable for us, but just we've got to consider ourselves to be experts in the space. We've got to feel good about the direction of the tenants in that space. So that when you think about all the boxes that we want to check, we could never get completely comfortable that was the right move for us at this time, at least.
So we're sitting here in May of 2025. We've been through a bit of a roller coaster with the tariff stuff. It seems like it's coming to a resolution, but just more generally, what's your take on the current economic environment or the macro environment?
I think coming out of the election or coming out of the end of last year, you really had some optimism. The Fed had started to take action. You knew the outcome of the election, right? People had some views as to which way the administration was going to take some certain policies. I can recall being at a conference where there was just a ton of enthusiasm for new store growth and M&A.
Yep.
And I think to date, for the first several months of this year, you haven't really seen a lot of that really come to fruition.
Yep.
It does feel like there's this willingness for people to transact and desire to want to grow. And I think we're just looking to get that stability, right, as a baseline to be able to act on that. Our businesses are all consumer facing. So obviously, if there's input costs that any of our tenants have that are subject to tariffs, they're going to attempt to pass that on to the consumer. One of the things we like about our portfolio is it's tended to do very well in, I'll call it recessionary periods where people have been trading down or you've been really focused on non-discretionary purchases. And if you think about just your wallet share, at the end of the day, after all of your fixed obligations, what do you have left to spend, right? You're going to take care of your car. If we're dining out at a sit-down restaurant, well, maybe you're going to trade down and
100%.
go to a QSR or go to a place that's got, private label fast food offering. even on the gas side, which, again, we're really focused on food and beverage inside the stores. But if you were going to fill up your tank and it cost $50, $60, maybe you're going to stop 3 times a week and spend $10 or $20.
Yeah.
And maybe you go into the store each time. So I think there's some real positives for our assets in these periods of a little uncertainty. But from a growth standpoint, when we think about how we're going to grow our business and work with our tenants, we really would like to see more stability so that our tenants can feel confident about taking that next leap, which typically requires capital from someone like us.
Yeah. Another curveball is kind of electric vehicles versus gas engines. What's your take on kind of the mix shift with EVs? There's certainly in certain parts of the country, they're more popular than others, but what's your take on that?
So I'll answer the question in 2 ways, which is if you have a store, right, and you're able to build that brand and connect with the consumer, whether you're driving a Tesla or some other type of EV or a combustion engine vehicle, you're still going to stop for your coffee or your snack.
Yep.
So I think it's really about shifting the mindset so that you're stopping at the C-store, whether or not you need fuel or not. And there's a stat today I think it's about more than 50% of customer visits are non-gas visits today.
Interesting.
We've seen higher than that, but that's generally something that we can support. The other thing that we're seeing, right, and it's very market specific, is if you're a new store build and you've got the ability to larger footprint, can you put charging in some parking spaces? And if you do that, can you add seating inside the store? Right. So from our tenant standpoint, whether or not they make money on the charge or not, right, they're getting you inside the store.
Yep.
And once you get inside the store, that they're making roughly 60% or even 2/3 of their profits from the store. Right. So they just want to get you in there. And then obviously the more time you spend in there, your transaction sizes go up.
Let's talk about capital allocation a little bit. I know you have a dividend that has consistently grown. I don't know what the yield is today, but it was 5-6%. And that has grown even through COVID, and other competitors cut their dividend. Maybe talk about the stability of the business as it relates to the dividend.
Sure. As a sector, net lease starts with the stability of our cash flows. So we're expected to have a recurring dividend that's set at an appropriate level. So for Getty, our dividend right now is about 80% of our adjusted funds from operations. So that gives us 20% free cash flow generation. As a board, we think about, what's the appropriate payout ratio so that we can not only retain some capital to invest, but also reward shareholders through dividend increases. So for us, I'd say it starts with setting it at the right level. And then we like to think about earnings growth, and then the dividend follows that. So if you look at what we've been able to do over the last 5+ years, it's like north of 5% per year AFFO per share growth on average. And so then when we think about today, if I'm a shareholder, Getty's growing its earnings 5+%, and I've got to call it a plus or minus 6% dividend yield. Well, that's a double-digit return, right, on what we think is a very stable set of cash flows. So we think that's pretty compelling, if somebody's looking at Getty for the first time.
Yeah, and in terms of investing in the business, maybe talk about the balance sheet and maturities and things like that. I think you guys are in great shape, right?
Yeah, so we're, again, long-term cash flows. We tend to finance ourselves with long-term fixed rate debt and equity. We refinanced our credit facility earlier this year, and then we closed on a private placement that we actually structured last year, but we closed in February of this year. Both of those addressed our only 2025 maturities. So sitting here today, our revolver doesn't mature until 2029, and then we've got an extension option at 2030, and our next debt maturity is not till June of 2028.
Yeah, a lot of wiggle room there, a lot of ability to continue to create value. And I always love asking this question because I was an analyst for 10 years, and I'd sit there and talk about stocks to some portfolio manager. And I always was nervous about the men or women who were like super quiet, because I'm always like, well, they're either really smart or they don't get it at all. I can't tell which one, but there's a lot of people who totally get the story. Are there some people who really don't get it? And what do you think they miss when they're evaluating the value of the business and the future prospects?
There's 15 to 20 net lease companies out there. Getty's market cap is called $1.6 billion today.
Yep.
Our enterprise value is maybe $2.5 billion. So we're firmly in the small cap area there. I think when you're looking at that many companies, sometimes we can be easy to overlook. And if you think about how much we've changed the business over the last decade,
yeah,
So if somebody hasn't looked at us in several years, and then we meet with them and they say, oh, you're just the gas station REIT from New York or from the Northeast. And then, we like to point out all of the changes that we've made. So I guess we always look to ourselves and say, what could we be doing differently? So we've changed everything that we can, except the name, by the way, which, who knows what we do with that. But we've changed our marketing materials. We've changed our messaging. We've changed our strategy. And so I think sometimes, just given the size of the company, we can be easy to overlook if you're looking for a much larger company or you're looking for somebody that's got a different strategy. But we continue to hammer away at that at every opportunity.
Yeah, therein lies the opportunity. It feels monotonous and can be frustrating at times. You just have to relentlessly tell the story. And then all of a sudden, you're like an overnight success after numerous years of doing it. Getty may not be the biggest player among all the REITs, but they come with a proven track record in the acquisition, financing, and the development of convenience, automotive, and other single-tenant retail real estate. The asset class is large and fragmented enough to present some pretty exciting opportunities for growth, and it's resilient enough to withstand some very serious economic headwinds. They continue on this trend of smart capital allocation. We definitely see Getty continuing to build on their incredible success. At Welcome to the Arena from ICR, we're working really hard to bring you exciting guests and great content. If you found this episode insightful, please subscribe to the show on your podcast app and leave us a 5-star rating. The more the show grows, the more interesting voices we can have on the podcast, and in turn, that should demystify a lot of the stakeholders around public companies and soon-to-be public companies. Thank you so much for listening. Special thanks to Chris Constant for joining us today. It'll be really interesting to catch up with Chris down the road as Getty's portfolio continues to grow on the back of some extremely strong secular tailwinds and fundamentals. This is Tom Ryan. We'll see you next time back in the arena.
References to specific stocks are not intended to be recommendations for specific trading behavior. Comments presented on this podcast are intended for informational and educational purposes only, and do not represent opinions or recommendations on whether to buy, sell, or hold shares of a particular stock. All investors are advised to conduct their own independent research into individual stocks before making a trading decision. In addition, investors are advised that past stock performance is no guarantee of future price performance.